Well, sentiment was shaky once more last week, with the S&P 500 notching its first back-to-back weekly declines since all the way back in April, as Treasuries rallied further and the dollar remained relatively firm against its DM peers. A monster week awaits the financial markets this week, though, with decisions due from the FOMC, the BOJ and the BOE, earnings on deck from 4 of the Magnificent 7, plus a packed data docket in the mix as well, highlighted, of course, by Friday's US labour market reports. There's tons for myself and Ryan Littlestone to discuss on the trade-off this week. So without further ado, let's roll the titles and crack on with the show. So plenty for us to be getting our teeth into this week. It is the week that has it all, as some have been saying. But firstly, just a little bit of housekeeping. Both myself and Ryan and Kyriakos, of course, are going to be taking some time off the desk in August. So we're going to be bringing you a show every other week through to the end of next month. In any case, Ryan Littlestone from Forex Flow Live and Forex Analytics joins me. Ryan, a very good Monday, sunny Monday morning to you. Sort of calm before the storm vibes this morning, I feel.
Morning, mate. Yes, very much so. This is going to be a rip-roaring, hopefully pip-scoring week ahead for markets. So looking forward to it.
Well, I'm not sure I'm looking forward to it, maybe with a sense of dread rather than a sense of anticipation and excitement that you seem to have. But, we will see what happens. And let's get our teeth into it straight away, because there is plenty for us to be discussing this week. So it was actually quite tough. I don't know about you, Ryan, but to whittle it down to 2 topics each this week. I think we could probably have done 8 or 9 topics each in this segment, but narrow it down we have. And I'm going to kick things off with a look at the FOMC, because Jay Powell and co are in focus once more this week. And I think it's going to be an interesting FOMC decision on Wednesday, because it's highly likely that the committee set the stage for a rate cut at their next meeting, which of course comes in mid-September. Now, of course, the Fed funds rate should remain unchanged between 5.25% and 5.5% this time around. The market prices next to no chance of any policy action. The sell side expect no policy action either. And of course, that would mark around a year at which the Fed have held rates at their terminal level. But of course, the market also discounts around about 100% probability that the Fed do indeed deliver a 25 basis point cut next time around. And that comes as a result of inflation continuing to move back towards the 2% target. We had the latest PCE metrics on Friday, where the core PCE figure came in at 0.2% on the month. When you annualize that on a 3-month basis, 2.3% is your annualized 3-month core PCE metric, which is a rounding error away from target. So the Fed couple that, of course, with continued signs of frailty in the labor market. The 3-month average of jobs gains per the payrolls numbers, that's at its lowest level since 2021. So the Fed have everything they need to deliver a rate cut very, very soon. And they're likely to signal that in 2 ways. Firstly, through the statement emphasizing that progress that's been made in establishing confidence that inflation is on its way back to 2%, and also likely making mention of how the labor market continues to come back into better balance. And you would expect that echoes those remarks at the post-meeting press conference. Now, I think the risks for the dollar perhaps tilt marginally to the upside here, with the curve pricing around 65 basis points of easing by the end of this year, which seems rather too punchy. But of course, it's also important to remember that I think this is going to be the first of 2 stages in the Fed setting up a cut in September. They'll lay the foundations now. We'll then hear from Jay Powell at Jackson Hole towards the end of August, where he will likely give a more explicit nod towards easing being on the horizon, and then that cut itself will probably be delivered at the next FOMC in September. But Ryan, what are your thoughts on the FOMC this week?
Pretty much aligned with yours, mate. It seems like it's a done deal. Nothing's going to happen at this meeting, and we're going to tee it up for September. We can never say never as traders. You know, there is still just a very, very minute risk that they may decide. Just to teach everyone once again that central banks are their own sort of men, and never rely on what a central bank is going to do. You know, if they drop a little cut next week, that will shock the markets. And as I say, remind people, you know, we can do what we want to do when we want to do it. But I think that's a minute risk. But a small risk is enough risk for us traders. But yeah, it's all looking like it's going to be teeing up for September. The data so far, nothing's falling off a cliff as we've been seeing. We were watching housing markets that had seen starts and permits and some of the other numbers. 3 months drops in those, and then all of a sudden last week we get a bounce again. So whatever happens with the US economy, this soft landing, whether it's going to hit a recession, it's not going to go in a straight line. So at the moment, we're still in soft landing mode. All the inverted curve recessionistas are getting taken to the woodshed again because they're going to be wrong and questioning why the curve hasn't produced a recession. Well, everyone knows that's not how it happens, but we won't go into that subject. But as you say, yeah, it's teeing up for September. It should be a boring one, but let's wait and see.
Oh, don't say that. You've probably tempted fate now. One thing that seems unlikely to be boring, and I'm even so unlikely to be boring that I'm even contemplating setting an early alarm for it, is the BOJ, which of course comes around 12 or so hours before the FOMC and the very, very, very early hours of Wednesday morning. Yeah,
very much so. And I think this one, there's sort of 3 clear paths to this decision. And what happens at the BOJ meeting really is on a bit of a knife edge at the moment. Market pricing is just edging over 50% on the hike side. But there's really more at stake than just interest rates. We've obviously got the question of QT, of cutting bond buys as well. Now, we watch the recent press sources that come out of Japan, and they're pretty much aligned with the market's view that the BOJ members are split on what to do. So some say there's enough evidence in inflation to justify a hike. Some others say that they want to wait longer until they see stronger consumption, a stronger economy is confirmed. I'm pretty much in the coin toss camp too. It's easier probably to highlight the potential outcomes. So I have a clear plan or way to react to whatever decision's made. So here's my sort of 3 simple outcomes to watch for. Firstly, the most hawkish outcome, which will be a hike, and announcing a cut to bond purchases. Second, doing one without the other, i.e. going with a hike but no cut to bonds, or vice versa, going with a bond cut but no hike. The first would be more hawkish, i.e. going with a hike but no bond cuts. The second would be moderately dovish, leaving that hike on the table. Thirdly, the most dovish is doing absolutely nothing at all, which is still potentially a possibility. Now, once we know which one it will be, we then need to judge the details. Is it a hike of 10 pips or more? The larger the hike, obviously, the more hawkish it will be. If bond buys are cut, how much will they be cut by? The consensus is that they're going to look to cut around 50% of bond buys over sort of an initial period. Then if they hold everything, so the most dovish, will they then give forward guidance that they're close to acting maybe at the following meetings? Now, overall, this is not really a meeting you can really pick a trading side for going in. It's one where you need to react to the news, and that might be the best play. I will say, though, given that this is the Bank of Japan and we know they like to keep things slow and steady, there's probably more chance the market gets disappointed and we see yen weaken than perhaps we see yen strengthen.
Yeah, I would tend to agree with that, and I'd also say you talk about the risk potentially that the Fed want to reassert a bit of control. I would say that if anyone's going to surprise, the BOJ are often the ones to do so. The other thing is, of course, we have had a lot of these sources stories in advance of the meeting, which you alluded to. I think it's interesting we haven't heard from the Nikkei just yet, and if you think back to when the BOJ delivered that first rate hike, the Nikkei were the ones who got the sort of inside scoop on that one, and gave everyone a little bit of forewarning. So I think that will be interesting to see if they do a similar thing and try and sort of tee the markets up for a certain policy action. But it is going to be interesting nonetheless. And I think there's clear signs of concern actually within the Ministry of Finance that the BOJ may perhaps go a little bit too quickly, because Bloomberg were running some reports last week that the MOF want the BOJ to go as slowly and as gradually as they can in stepping back from the bond market, which isn't entirely surprising because, of course, they've got a vested interest in keeping yields relatively low.
Yeah, that's right. And, around this hike number, will it be 10 pips, 15 pips, 20 pips or whatever? Again, they have to manage that because, they own in half the bond market. If they move too much too big in rate hikes, then that's going to upset the market a lot, put a lot of pressure on the government and their borrowing. So as we've been saying, this is Japan. They're in a big hole, and they've got to crawl out of it very slowly.
Yes, indeed. Right. The final central bank decision that we have this week, last but by no means least, is the Bank of England. And yes, it is true. I've changed my mind again. I'm flip-flopping around with my forecast as much as the central bankers who actually decide rates are flip-flopping around themselves. So my base case, and I'm not going to change this because I've actually written this down and published it in a note which is on the Pepperstone website if anyone wants to have a read, is that the BOE will indeed deliver a 25 basis point rate cut this Thursday lunchtime, and that rate cut will be a 6-3 vote. When you work it through, it is tough to have a high degree of conviction in this call, given how finely balanced things are. But when you work it through and you look at recent remarks and you look into the minutes at the rationale for why policymakers voted as they did back in June, the logical takeaway is that we will see Haskell and Mann remain in favour of keeping rates unchanged, probably joined by Chief Economist Hugh Pill, who made some relatively hawkish remarks recently, which does raise the interesting prospect of the governor of the BOE and his chief economist being on opposite sides of a vote, which I'm not sure has happened, certainly not recently. Maybe it's unprecedented. As I said, though, the decision is very, very finely balanced. The market is pricing the meeting as an almost exactly 50-50 split between leaving rates unchanged and the BOE delivering a 25 basis point cut. But I think there's two reasons why they will cut. Firstly, is that those who saw it as finely balanced to leave rates unchanged in June. The key thing that they pointed to was the fact that recent services inflation data had not significantly altered the disinflationary trajectory of the economy. Has recent data changed their mind on that? I would argue not, given that a few one-off factors were underpinning the upside services inflation surprise that we saw in the June data that was released a couple of weeks ago. And the second one is more of a logistical matter, and that is that if the BOE want a press conference and a set of new economic forecasts to explain what they're doing in terms of policy, they either do so now and deliver a cut, or they're waiting until November in order to deliver the first cut of the cycle. And arguably 15 months with bank rate at a terminal level at 5.25% would probably be too long. So that is where I'm thinking. I think either way, it's going to be a very, very significant vol event for the pound. 1 week implied volatility in cable is at its highest level roughly since the last BOE meeting, actually in mid-June, pricing a range of about a big figure over the week. But Ryan, what are your thoughts going into the old lady's announcement on Thursday lunchtime?
Well, I think they've been successful again in tying you up in knots over what they're going to do. That seems to be their MO. Yeah, that seems to be their MO for the rest of us. We've had this game all the way through the year. Is it going to be June? Is it going to be July? Is it going to be this? Is it going to be that? September, August? And I said I think it was the last trade-off we did, or the one before. If you take the inflation data that we've had since the last MPC meeting, nothing's changed. Inflation was unchanged. The wages numbers in the jobs numbers were unchanged. So on that front, there's nothing that should change the mind of those who were sitting on the fence previously. However, we know they're desperate to cut. We know that Bailey's previously said earlier in the year that they don't need to wait for inflation to get to target before they start cutting. Well, here we are at target for 2 months on the trot. And that one small cut wouldn't really make a difference. It would just get them on the road to cutting further. So for me, it's always been they wanted to cut. I always thought August was underpriced when everyone was shifting out to further in the year, September. So the risk is that they would cut this meeting. I think it's on. But then you wouldn't be surprised if some of them did sit on the fence, still wanted to wait for a few more months until we get to September. So yeah, it really is a 50-50 decision. At the very least, we will get a vote number that would suggest September is nailed on if they don't cut this meeting. But yeah, they could cut this meeting, they might not cut this meeting, and we'll be having this conversation in a week or two's time and still tied up in knots. So Yeah, and good thing about 50-50 decisions, it's going to give us two-way volatility for trading the pound, and that's all we're interested in.
Yes, indeed, you're absolutely right. It is, as my good friend Ryan Paisley mentioned about half an hour ago, an old-fashioned policy decision where no one really has a clue what's going to happen as we go into 12 o'clock on Thursday lunchtime. In any case, moving on, there is plenty else going on this week besides central bank decisions. We've got the quarterly refunding announcement from the Treasury, a whole host of corporate earnings. I think 40% of the S&P by market cap report this week, but also a busy data docket as well.
Yeah, very much. We've still got data points to get through as well. Monstrous week of data too. And while some of it may play second fiddle to the central bank meetings this week, others will be important for those meetings. So from the Eurozone, we start getting flash inflation numbers for July. Now, while many of the ECB members may be cleared off for their holidays, the market will be watching these closely with an eye on the September meeting and another possible cut. Tuesday, we get Spain and Germany. Wednesday, we get France, Italy, and then the pan-Eurozone number. For the US, it's obviously jobs week. So JOLTS Tuesday and ADP on Wednesday will be the key numbers to watch pre-FOMC. However, a more important data point pre-Fed will be the Q2 employment costs and wages indices, as these numbers are firmly in the deliberations of the Fed members. Employment costs, are expected to drop versus Q1 by about a pip, so they're expecting those to come down. Now, post-Fed, we get Q2 non-farm productivity and unit labour costs, so some more sort of wages numbers in there. And then on Friday, it's the big non-farm payrolls. Now, as much as they come after the Fed, these numbers will be important for matching up against whatever comments the Fed deliver at this meeting. If they're expecting some job weakness, they may be giving us a little bit of a clue that we're getting a soft one from future job numbers. If the Fed haven't cut and they've set up September, this data might be used to judge the next ruse after September, i.e., are we going to see 3 cuts, 2 cuts, more cuts coming for the rest of the year? So it's all about numbers pre-Fed leading into it and numbers after the Fed as to how that matches up with their message. So big data to watch, lots to get stuck into. I hope you're going to put your NFP competition number up nice and early.
Yes, 12 o'clock Friday lunchtime, as usual. I noticed that you're putting your payrolls tweets out even earlier than usual now. If people are watching and have got no idea what we're on about, do go over to, is it the Forex Analytics Twitter page? You're running your non-farm payroll sweepstake competition, so do go get involved with that just for a bit of fun. I will be putting my guess in due course. I do think the jobs number is going to be interesting because the metrics have been softening recently. Clearly, unemployment at 4.1% is its highest level since 2021. The 3-month average of job gains as well. We had a net minus 111,000 revision in June to the prior 2 months worth of data. That dragged the 3-month average of job gains to 177,000. Which is also its lowest level since 2021 and quite a long way below the break-even payrolls rate, which is around 225, 250-ish, which is the rate at which payrolls growth needs to be in order to keep pace with growth in the size of the labour force. So clearly some cracks beginning to emerge. The JOLTS data will be interesting on Tuesday as well, albeit that does reference June, of course. ADP is not worth the paper that it's written on, as has been the case for some time. But of course, we also get a whole host of PMI surveys this week as well. I know it's final data for most of the world, but China, the NBS PMIs, they may be of particular interest, especially for commodity traders out there. We've seen some softness coming through, particularly in crude of late. So particularly looking for signs of a pickup in the Chinese manufacturing sector. And then, of course, we get the ISM manufacturing figures from the United States, which I think are due on Thursday afternoon after the BOE, which will also be of interest. So, yeah, it really is something for everyone in the next 5 trading days or so.
Yeah, very much so. And, going to need watching those numbers very closely. The NFP, well, people keep expecting it or waiting for it to roll over and we get a really bad number, negative number, and it just hasn't happened. You're picking the bones out of it where, finding weakness within that. But, the headline number is still coming up, plus 150,000, so it's still strong. And the same again with that jolt. We'd seen it coming down from 10s to 9s to 8 millions, and then we got that bounce again. So it's just like the housing data. You see things coming down, and all of a sudden, boom, you get a good number, and the market goes, oh, we're wrong again on calling for bad news.
Very much so. What have you put your payrolls guess in yet?
I have.
Oh, what is it?
I can't remember. 123K.
Oh, right. Nice and easy. Right, let's move on and dig into some charts. Okay, so plenty for us to get through this week in terms of charts. I want to kick things off with a look at the equity space in the United States, because we saw some further selling last week. As I mentioned in the intro to the show, the S&P 500 notching back-to-back weekly declines for the first time since all the way back in April. Although it's worth noting that some of this move lower that we've seen at an index level is still part of the rotation that we're seeing. The Dow, and to a greater extent the Russell, remaining more underpinned than some of the tech heavier indices that are out there. But nonetheless, it is noteworthy that the front S&P future now trades below the 50-day moving average for the first time since May, although we are trying to work our way back above that in early trade this morning. And the Nasdaq also trades below its 50-day moving average, but held on to its 100-day moving average for now. My view is still firmly that this is a blip rather than any sort of change in trend. And actually, if it is a rotation that we're seeing, that is probably healthy for the market in the longer term, because it increases and broadens out the rally and allows market leadership to become a lot wider than it otherwise would be. The bull case that I've had for most of the year has been conditioned on strong economic growth, strong earnings growth, and the Fed put remaining in action. And all three of those factors remain in place. We had GDP out of the US last week, which showed the economy growing at an annualized 2.8% on a quarterly basis in the second quarter of this year. S&P earnings growth is on track for its best quarter since the back end of 2021. And of course, the Fed are on track to deliver a rate cut as soon as September, and that should be the first in a series of cuts. I think the market may have lacked a little bit of conviction to buy the dip last week as we move into what is a busy week of earnings season this week, with of course 4 of the Magnificent 7 set to report. But if we get strong earnings accompanied by decent guidance there, then that could be the catalyst that the bulls need to reassert control. But over the medium term, I think dips are still there to be bought, and the path of least resistance continues to lead to the upside.
Absolutely. There's not much to say about this one. For traders who are trading this every day, I think context is needed for some of these stock indices, particularly the US. You look at that chart there; it's a more longer term chart. This just looks like a mild pullback. If you're trading off a shorter term chart, an hourly, something like that, these moves do look much bigger in magnitude. So it's always worth switching in and out of your time frames just to see the wider picture. What is this looking like? Is it looking like a complete change of trend, or is this just looking like a pullback? Because then that can set you up for trading your levels. If you have some levels further down, decent support that will maybe former resistance areas on the way up, then those are the levels you want to wait for. Just have some patience. If you get down to there, that's maybe where you try and buy a dip. Conversely, if you want to be shorting it, you need to see sort of multiple highs forming a level above where the price isn't getting through and not getting back to the all-time highs. Then that gives you a bit of an area to trade for the downside and getting into shorts. But it's a very interesting time at the moment. There's lots going on in stock markets. We've obviously got the US elections coming up. We've got this rotation. We've got this data. We've got the Fed. So I think this week might be a bit choppy until we get further data, know what the Fed's doing and the rest of it. Then maybe after that we'll get a bit of a clearer idea where stocks want to go from here.
Indeed, plenty of moving parts. Speaking of which, dollar yen, there's plenty of moving parts there as well.
Oh, this one's non-stop moving at the moment. and I'm going to sort of try and highlight the two-way risk for this one. Now, if I'm going to be honest, I would advise many traders to steer clear of this pair this week because it really is volatile at the moment. We're getting some big old swings just out of nowhere. So, it's becoming pretty hard to trade. But it would be remiss of me not to sort of lay out the risks for moves this week. We're obviously coming into coming off of two very big moving weeks. We've done nearly 1,000 pips in the last 2 or so weeks. So the first thing to be aware of, as I mentioned, is the volatility in this pair. And as we have both the Fed and the BOJ and big US data, that vol isn't likely to dissipate anytime soon. Now, as the BOJ comes before the Fed, as mentioned, the first risk is really all yen related. Remember, when trading a currency, there's two sides to it. So know which side is at risk at any one time. Now, one thing that was confirmed on the charts last week was the solidity of that 152 level. This is a monster level we've been highlighting for quite some time. It goes back to 1986, and it held like a demon last week after pretty much the
like
pair carved like a demon. And I'll just get it from wherever I find them. But anyway, it carved through every other technical level on the way back down, and some of those were some quite big levels as well. However, while some of those levels on the way down haven't done much, on the way back up, there may be a different matter. So keep an eye on those levels that we came through last week, because we might find them as resistance on the way up. So if you want to trade really a simplistic view, watch the 152 level and 155 levels. These have been pretty big levels. The latter of which, the 155, confirmed its break by holding right after. So we broke through 155, bounced immediately back to 155, and it held. In between, we have some support around the 153 level and a sort of bit of intermediate level at 154, 2025. That was the bounce point after the 152 test, but a level that we failed to hold above, prompting that retest to 153. Now, one last warning, be mindful that Japan's Ministry of Finance might still be lurking. If the Bank of Japan do nothing at their meeting, we're probably going to get a spike up, and they may be waiting in the wings again. Today, also, we should get the Ministry of Finance's intervention report, which will tell us exactly how much they intervened for and whether they intervened sort of some other times outside of those big intervention moments. I have a feeling that they changed tack and they were giving it a nudge here and there after certain events and data points. So, yep, lots in the mix for this one. Be careful if you're trading it and know your levels.
Yeah, plenty in the mix here. And I would actually just second your advice of steer the hell clear of this, at least this week. There's far too many moving parts to get a clear read on what's likely to happen. You've got the BOJ, you've got the Ministry of Finance lurking, as you said, you've got the Fed in the mix, you've got the quarterly refunding if the yen is going to become a rates trade again. You've got a big week of economic data, and of course a big week of earnings, and the yen is traditionally a risk proxy too. And amid all of that, you can have as many technical levels on the chart as you want. A lot of them might not mean anything, and we could see some pretty violent price swings. So I think if you are trading dollar yen this week, risk management needs to be absolutely pivotal, as always, but even more so than always. And if you haven't already got a position, then I'd be inclined to wait until the dust settles and then pull up a chart next Monday morning and reassess things.
Yeah, and there's plenty more other pairs you can trade and assets. So if you want to leave the yen alone, then do so.
Absolutely. One of which is gold. That was a very smooth segue, mate. Gold looks like it's back in the range, actually. We've had a little bit of a pullback from the record highs that we saw, well, a fortnight ago now at $2,483 an ounce, with gold experiencing further downside last week. And I think it's worth noting that if you are bullish on the yellow metal, all of the signs pointed to gold that should have been rallying last week. If you look at the textbook, Treasury yields, I should say, moved lower across the curve. The dollar remained relatively soft, and risk appetite was clearly relatively weak. But gold couldn't find much by way of demand, although it is worth remembering, of course, that price did find support at the 50-day moving average on both Thursday and Friday, which comes in at $2,360 an ounce. As I said, it does look like we're back in something of a range at the moment, with sort of 2,420, 2,430 as resistance to the upside. Support below comes at 2,300, and the 100-day moving average about $25 above that, with the 50-day moving average slap bang in the middle of that range. So I think this is a relatively easy one to play from a purely technical standpoint, as long as we're above, buy the dips into the resistance to the upside. If we get a closing break below, then perhaps look to sell and target the support levels that we flagged below. But I think if we are going to see another move towards record highs, then it does obviously need us to make a closing break north of what are now those three key resistance levels to the upside. But I think it is perhaps concerning once again, and we saw this earlier in the year where gold completely detached from its fundamentals. It's perhaps concerning that appears to be happening once more.
Yeah, it's been a bit of a messy one. We thought we were off to the races the other week when we made up those highs, broke the 2450, shot up to 2480s. Then we came down pretty quickly. The 24 level was looking like it was holding last week. I think that was my play of the day last week to trade it down into sort of 2390s, 2385s, that sort of area. We did have a little dip through. I managed to mess up a trade there myself, trying longs there. But then it bounced up to, as you say, 2430s. And before coming back very quickly. So, yeah, we're staying in that wider range, between, let's call it 24s and 23s at the moment. And you look at your levels, your extensions either side of that. So it's not quite ready to take off again, which is a bit of a concern for those, maybe longer term longs. We've seen a real strong rally over the last, year, 18 months. It's not really doing anything more. So, this might be something that people are watching the clock. If we don't get a break higher that really takes off, it might be that we're going to see a steeper pullback, and we might be going back to 22, 21, or maybe even 2000 again. So again, keep your wider time frames in the shot as well. Don't get sucked into the intraday price action too much.
Indeed, yes. Right, one thing we didn't mention when we were talking about dollar yen was the carry trade and the broad unwind that we appear to be seeing. The Swissy was also quite a chunk firmer last week, some decent strength coming through in the lower yielding parts of the G10FX space, and that carry unwind seems to be coming through in EM as well. Yeah,
I could have made a carry-on joke about that, couldn't I? But I'll say that. God. I'll say that for next week, I think.
Oh, matron.
Yes, matron. The big moves in the yen that we saw last week, they were felt across many assets, many other pairs. He's gone again. Look at him. I don't know. Go and get yourself.
Carry on. Don't mind.
It was the move in the yen was felt in many other pairs and assets, and one in particular being this carry trade. Because carry traders have long been borrowing in a low rate yen to put into higher rate FX and assets around the globe. And the MEX has really been one of the biggest. One of the biggest carry trades has been short dollar MEX. And that saw a move that broke an important level, the 1850 level on the upside. Now, it could be said that we've broken this level previously, with the last time being driven by this Trump trade, as we're calling it. His views on Mexico are a bit negative for the currency. Now, just a little bit. You never know with Trump. But what is very important, though, is that we haven't managed to break this level and then hold on to it. So we haven't made a clean break and hold above this 1850 for any time at all. This level really is the doorway to a move maybe back as high as the 20s or even more. I'm moving firmly into a dip buying camp, and I was waiting for a move to 1740 when we came off that Trump high to load up longs after that June failure at the 1850s. But unfortunately, we only got low as the 1760s. I do believe dip buying is still valid, but if that wasn't to happen, I would look to go long on a solid break and hold of this 1850-51 area for a move up to at least the 50% fib of the 2021 move down, followed by the level at 1980, which is a bit of a confluence of the 61.8 fib of that 2021 move and the 38.2 of the 2020 move. So there's a lot of tech confluence up above that I'll be looking at if I get into longs, whether it's at 1740 or a break at 1850. But for now, my bias is to buy the dips, and I see this going much higher.
Good stuff. Yeah, I think the whole idea of the carry trade unwinding is an interesting one across the board. We've seen it in the yen, we've seen it in some of the LATAM pairs, we're seeing it in the Swissy, as I said, and maybe even in the equity space as well. Just a broad kind of de-risking appears to be going on, and I guess that's not particularly surprising given that we're the time of year everyone is mulling over their summer holidays. I mean, you're almost already on the beach at this point, I know, and many other people are going to be thinking along similar lines. But of course, another thing to bear in mind with carry is, particularly in the FX space, carry only really works in an environment with low vol. And over the last couple of weeks, vol has been moving quite substantially higher across the board. And I think that is giving people another incentive to begin to close out some of those positions, because it's all well and good having, a 5% carry. But if you've got a 3% adverse market move since you opened that position, well, your 5% is now only a 2% return, and very easily it could be a negative return. So I think that may be giving people cause to ponder some of these trades as well.
Yeah, and it's also a matter of timing as well. These things tend to happen in waves. I mean, if you were in this carry trade from sort of, late 2020, 2021 up in the 22s, 23s, you're not really getting worried too much at the moment. But if you were coming in 2022, 2023, closer to where we are now, shorting this sub 20, you're seeing this big bounce from 17s. You're going to be getting a bit nervous about this, and that's going to force the short-termers out in waves. They're all going to have their stops sitting there. So that's why you suddenly get a move. It's a big move, then it pauses, then you get another move. So, yeah, I think you've got to, and that's why the fibs are going to be important. They're always important to me in trending markets, because it tells you when this is really changing around. And as such, you're going to get people folding their positions and taking the money off the table. Nothing lasts forever, as we know in trading.
No, absolutely not. I think it's a kind of classic sort of last in, first out scenario, where those have kind of jumped on the bandwagon recently are obviously more keen to get out sooner, because they don't have that sort of cushion upon which they can lean. In any case, let's crack on with our plays of the day. Right, so we're both looking at the pound this week. We've got a funny feeling we may be looking at things in a slightly different way. As we alluded to earlier, cable, which I'm looking at here, is likely to be pretty damn volatile this week, with the BOE decision priced as a coin flip and effectively binary, I would argue, in terms of the reaction that we see. If the old lady leaves rates unchanged, we're likely to see cable rally towards the 130 figure. And if they deliver a 25 basis point cut, then the 50-day moving average around 127.75 is likely to come into view in relatively short order. If we were to get any rallies, though, on the BOE leaving policy on hold, it's a rally that I would be looking to sell into, and there's a few reasons for that. Firstly, the BOE are still going to deliver a rate cut, perhaps not in August, but certainly sooner rather than later. Secondly, and we're likely to hear more on this later today, we're going to have some pretty sizable fiscal tightening here in the UK, which will be a fairly chunky growth headwind. And of course, that comes at a time when the US is still vastly outperforming its peers in the rest of the world, having grown, as I said earlier, at an annualized rate of north of 2% in 7 of the last 8 quarters. And I think in that environment, it's still tough to bet against the greenback. Even if the Fed are about to cut, Fed pricing does look rather overdone, with about 65 basis points in the curve between now and the end of the year. So if cable has another foray up towards or even north of 130, then I'd be looking at an opportunity to get short and fade that move. But Ryan, I have a feeling you may be about to disagree with me.
Well, I don't know about disagree. There's always there's plenty of ways to trade this market, and I'm keeping this one strictly about the levels in euro sterling. You've just mentioned you want to sell rallies in cable. I want to buy dips in this pair, and by selling it into the 85 level. Now, for clarity, I've been short of this 85 level for a while and taking profit pieces down to the 84s. So I'm really just looking to add those back into my core short position and sort of just do a rinse and repeat offloading in some of the dips if they come along. We've shown that this 85 level is a huge level on this show for many months, and that was when we were above it, and I'm happy to use it as a trade while we're below it. Further downside will come if we manage to break the 84 level and this new support area at 83, 85, while a move back above 85, 85.20 would tell me that maybe we're done with the downside. Obviously, there's lots going on with the Bank of England and everything there. But this it's sticking to the levels pretty tightly, and I'm happy just to play it purely from a technical basis, more so on what's happening with the Bank of England.
Good stuff. Thank you very much, mate. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. And, of course, to our producer, Kyriakos, for bringing this together as brilliantly as always. Thank you very much indeed for watching. If you've enjoyed the show, please drop a like on the video. Leave a comment as well. Let us know how you're trading the markets and if there's anything you would like us to discuss in the next episode of The Trade-Off, which, as I said earlier, is coming in 2 weeks' time. We're doing a show every other week through to the end of August, taking some time off the desk, and I would strongly advise that you do the same if you can. In that case, we will leave things there. Thank you very much, as always, for watching. We'll see you in a fortnight, and goodbye for now.